An irrevocable trust is completely different than a revocable trust. Obviously, as you can tell by its name, it's an irrevocable versus a revocable, meaning that an irrevocable trust can't be revoked, and generally it can't be changed either. In an irrevocable trust, you still have a grantor, which is the person creating the trust. Sometimes it's called a settlor. That's the person transferring assets into the trust. But an irrevocable trust is different in a revocable trust, in that you typically in an irrevocable trust name a third-party trustee, which means that you're giving up power over all of the assets that you put into the irrevocable trust. Because if you're not the trustee and a third party is the trustee, then the third party trustee is the only person that can deal with the assets within the irrevocable trust. There are several motivations for creating an irrevocable trust. The general concept is it's because you're trying to give up control of your money for some reason. For example, it can be used with some estate tax planning if your estate is over the federal estate tax limit. Sometimes people will create irrevocable trusts to do some sort of Medicaid planning. It's a very aggressive option, and it's not commonly done. When the estate tax amount was lower years ago, irrevocable trusts were more common, and they were typically funded with life insurance, but they're not as common as they used to be. They can be an administrative burden after you create them, because they do have to have their own tax identification number through the IRS, and you do have to file an annual tax return for an irrevocable trust if it earns enough income to justify that. An irrevocable trust must be always carefully considered, and all of the options reviewed with your attorney and your accountant to make sure it's the best plan for you.